Welcome to the Commodities Institute podcast, your daily breakdown of the global commodities markets and the forces moving them. I'm Emily Costa. Today is Friday, May 1st, 2026. We are entering the third month of the conflict between the United States, Israel, and Iran. And the ripples across the global resource landscape are no longer just ripples. They are massive breaking waves. Today, we are looking at a world where the primary arteries of trade are being constricted, from the energy corridors of the Middle East to the rice paddies of Southeast Asia and the gold vaults of Mumbai. We begin today with agriculture, where a quiet crisis is brewing in the world's most essential staple. Rice supply is under immense pressure, and it is a classic case of a double whammy. On one hand, the war has sent the cost of fuel and fertilizer through the roof, and on the other, we have an emerging El Niño weather pattern threatening to parch the land. In Thailand and Vietnam, smallholder farmers are facing a grim reality. I'm looking at reports of farmers in Thailand's Chai Nat province who have seen production costs jump from around 4,500 baht to 6,000 baht per rye. With the price of unhusked rice sitting only slightly above that, the margins have evaporated. This has forced many to cut their fertilizer use by half, which is a move that inevitably leads to lower yields. The Philippines, the world's largest rice importer, is in an even more precarious position. Experts are warning that domestic output could fall by as much as 6 million tons from its typical 20 million ton average. While global inventories remain somewhat cushioned by India's record 42 million ton stockpile, the United Nations Food and Agriculture Organization is warning that if the Strait of Hormuz does not reopen within the next 2 to 3 weeks, the global food security situation will shift from strained to serious. While Asian farmers struggle with inputs, the American biofuel industry is facing its own trial by fire. The Environmental Protection Agency has laid out its most ambitious biofuel blending mandates on record, setting biodiesel and renewable diesel requirements at 5.4 billion gallons for this year. To hit these targets, processors need to boost production by over 60%. It is a massive ask for an industry that only produced 2.9 billion gallons last year. In states like Iowa and Minnesota, plants that were idle just months ago are scrambling to ramp up to full capacity. However, the hurdles are significant. Steel and aluminum tariffs have driven up construction costs for expansion, and logistical bottlenecks remain a persistent headache. If the industry fails to meet these quotas, we could see diesel prices climb even higher as refiners are forced to dip into their credit banks. Moving from the fields to the vaults, we are seeing an extraordinary development in the precious metals market. Gold imports into India, the world's second largest consumer, have plummeted to a near 30-year low. In April, imports fell to just 15 metric tons. To put that in perspective, India averaged 60 tons a month over the last fiscal year and typically spends about $6 billion a month on the yellow metal. This April, that figure was likely closer to $1.3 billion. The culprit is not a lack of appetite. Indians were celebrating the Akshaya Tritiya festival, a major gold-buying occasion, but rather a sudden tax dispute. Indian customs began demanding a 3% integrated goods and services tax from banks which were previously exempt. Until this is resolved, millions of dollars worth of gold is sitting idle in vaults, unable to reach the jewelers. On a different note, in the metals space, we are seeing a slight thaw in the trade tensions between Washington and Beijing. China recently approved a 60-ton shipment of yttrium oxide to the United States. This is a critical rare earth element used in aerospace engine coatings and chip making. While this shipment is 50% larger than everything China has sent since last April, overall exports of this material are still down 75% year over year, keeping the aerospace sector on high alert. Of course, the central engine of all this volatility remains the oil market. The United States' naval blockade of Iranian ports has effectively strangled Tehran's ability to move its crude. Exports have cratered, down over 80% from March levels. We are currently tracking 41 tankers sitting off the coast, holding 69 million barrels of oil that Iran simply cannot sell because their onshore storage is nearly at its 86 million barrel capacity. And this has pushed the Iranian rial to a record low and is forcing the country to consider cutting production within the next few weeks. But the oil story took another turn this week, with the United Arab Emirates announcing its withdrawal from OPEC. In a normal market, the exit of the fourth largest producer would signal a price-cutting war. However, with the Strait of Hormuz effectively closed, the UAE's ability to ramp up its production from 3.3 million to 5 million barrels per day is purely theoretical. You cannot flood the market if the gate is locked. The big question now is how Saudi Arabia and Russia respond. If they decide to engage in a volume war to squeeze out United States shale, it could create a geopolitical earthquake just as the American election season heats up. In the power and carbon sectors, we are seeing the financial toll of this uncertainty. Australia's Woodside Energy is hitting a wall with its planned Louisiana liquefied natural gas facility. They are trying to charge liquefaction fees of $2.80 per million British thermal units, but buyers are pushing back, looking for rates closer to $2.40. It seems that even with the global energy crunch, there is a ceiling on what the market is willing to pay for long-term security. Meanwhile, in Europe, analysts have slashed their forecasts for carbon prices. The European Union's carbon permits are now expected to average about €80 per tonne this year, down significantly from previous estimates. The market is betting that the energy shock from the Iran conflict will eventually lead to demand destruction, meaning industrial activity will slow down so much that companies simply won't need as many emission permits. Finally, we turn to the shipping lanes and the ongoing friction in the Black Sea. Ukraine has successfully used diplomatic pressure to turn away a vessel named the Panomitis from Israeli waters. Kyiv alleges the ship was carrying stolen grain from Russian-occupied territories. President Zelensky has vowed to target what he calls the shadow grain fleet with the same intensity as the shadow oil fleet. This comes as the European Commission trims its soft wheat export forecast to 27 million tonnes for the current season. While European wheat production for next year is expected to be higher than previously thought at 127 million tonnes, dry weather is already raising concerns that those gains might be short-lived. It is a complex, interconnected web where a naval blockade in the Gulf of Oman can eventually lead to a more expensive bowl of rice in Manila or a higher carbon price in Brussels. We will be here to track every move. If you found this episode valuable, be sure to subscribe, share, and leave a review. Find us online at commoditiesinstitute.com.